We're getting more earnings from the U.S. financials. Charles Schwab, U.S. Bancorp, and Bank of New York Mellon are among the companies reporting this morning. Our guest says this industry, the financial sector, looks like it's going to have significant growth into 2026. We are joined by Eddie Ghabour, CEO at Key Advisors Wealth Management. Eddie, always great to see you. Thank you very much for joining us. Talk to us about the U.S. banks. Is this a pretty sweet environment for them with interest rates coming down?
It really is. It's going to be a Goldilocks environment for the financials. And we're really looking right now from a positioning perspective for our portfolios in regards to where we think things are going to be 6 months from now. So short term, we definitely expect some volatility to pick up. When you look at the VIX showing higher highs, the dollar has shown a little bit of strength. But at the end of the day, one of the biggest things for financials here in the U.S. is the deregulation. One problem we have here in our economy is housing. And one thing that's on the table from a housing perspective is to change some of the regulations for banks to loosen things up to allow them to lend more money. And if we get that with 2 rate cuts that we expect, there's going to be a tremendous amount of liquidity that goes into the U.S. economy over the next 6 months. So we actually expect economic growth to accelerate in the first quarter next year. And that will put the consumer in a better spot, housing in a better spot. And that's a really sweet spot for banks. So we really like financials going into the end of the year, but more bullish as we go into the first part of 2026.
That's interesting. Of course, low quality mortgage bonds were one of the big problems in the 2007, 2008 financial crisis. Government has been wary of real estate deregulation over the past decade and more, but you reckon that boost is coming?
I do. And look, history has a tendency to repeat itself. We are in a bubble right now with asset prices, right? And the term bubble should not be considered a bad term. A bubble means asset prices are going to inflate and probably go higher than many people expect. The problem's going to be when that bubble pops. Right. And they always do. They always pop. And that's at the end of the day going to be when investors need to be very diligent about knowing when to de-risk. But these types of things are going to cause asset prices to inflate, whether you agree with the policy or not. And that's what we tell clients is we're more focused on what that's going to do to asset prices versus whether we agree with it or not.
Yes. It's interesting what you say about bubbles. They're only a problem when they pop. It's a bit like jumping off a building. That's not going to kill you. It's the collision with the ground. I'm getting very dark here. Well, I guess it's almost Halloween. Tell us what your view is on Charles Schwab. Is that an attractive stock?
I think what you're going to see is these financials that have wealth management tied to them, with the market doing what it's doing, you're seeing more and more trade activity from wealth advisors around the world. And so these types of financial institutions are going to do extremely well in this type of environment. And so I would lean more towards that than just your traditional bank. So I prefer the financials that also have wealth management tied to them, because that business is booming right now, obviously because of this bull market we're in. And as long as that continues, which we expect in the first half of next year, those financials should be able to continue to show strong earnings and guidance moving forward. Because think about it, we've had some slowing economic data, and their outlook still looks pretty good overall on a net basis when you look at the earnings that we're seeing.
You have, just to stick with the financials here, one idea you have for the viewers here is XLF. It tracks the big U.S. banks, an ETF.
So for our clients, and of course you have to have the right to risk tolerance, we use a lot of ETFs because we can get exposure to all of the major institutions. And this ETF allows you to get the best of breed names without having to just pick one. Because if you pick the wrong one, you could be right on the sector, but still lose money. So this to me is a safer way to diversify and get direct access to a sector that we believe will do very well.
Yeah, it's interesting. You can have just a very well-run company will suddenly hit a problem. For years, well, TD Bank was a darling, and then it ran into problems with the money laundering regulations in the States. You also think you see promise in the smaller banks, the regional banks in the States. KRE is an ETF there.
Yeah, so based on our thesis that the economy is going to get stronger and the consumer is going to get stronger, and we'll see some deregulations in the banks and lending standards, that's going to benefit your small regional banks even more. They're more aggressive, higher volatility, but in that type of environment, you're going to see these regionals have higher upside potential. And this is why you're seeing small cap indexes do well and outperform the S&P on a relative basis here recently because of their exposure to some smaller regional banks. So it's a much more aggressive play than the XLF, but it is a play on the economy accelerating in 2026. So again, just our theme is bullish on financials going into next year.
It's interesting. The smaller banks tend to take more risks with their lending, or they'll go out on a limb more for local entrepreneurs.
Well, that's it. They're working with smaller businesses. So smaller businesses have a higher potential for default than a large corporation. So it's a higher risk business model. But at the end of the day, if we are going to see that reacceleration, you will see these smaller regional banks be more aggressive in lending money to small businesses. And you have seen small business sentiment kind of go down. And so when you start to see it tick back up, that appetite for borrowing more money from smaller businesses will increase, and those banks will welcome that. So that's kind of the setup that we see, is we think we are at the bottom of the sentiment, negative sentiment for small businesses. And once we get our government reopened and policies in place, I think you're going to see that sentiment go ahead and take a straight line up.
Thank you very much, Eddie. Great to hear from you.
Thank you.
Eddie Ghabour, CEO at Key Advisors Wealth Management.